Do you ever wonder why some businesses thrive while others struggle? The secret isn't just having a great idea. It's about the right mindset, strategy, and execution. In today's video, we're uncovering the most powerful business strategies that can help you stay ahead in an ever-changing market. If you're serious about success, hit that like button and subscribe. We bring you expert insights every week. Plus, turn on notifications so you never miss out. And drop a comment below. What's the biggest challenge you're currently facing in business? Let's talk. Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. Ronald Reagan. Inflation, often described as the silent thief, erodes the purchasing power of your money over time. While it may seem like a distant economic term, its effects are very real and personal. The rising prices of groceries, gas, and housing are just a few visible signs. But what about the hidden effects? How does inflation impact your savings and investments? And what can you do to protect yourself? What are the implications of inflation on my savings and investments? Do you truly understand what inflation is and how it affects your financial health? Consider these questions. Can you explain what inflation means in simple terms? Do you know how inflation impacts the purchasing power of your savings? Are you aware of how inflation influences your investment returns? Understanding inflation. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. It means that over time, each dollar buys fewer goods and services. For example, if the annual inflation rate is 3%, a loaf of bread costing $1 today will cost $1.3 next year. This may not seem significant in the short term, but over decades, the impact is substantial. Consider Violet, who saved $10,000 in a savings account with an interest rate of 1%. With an inflation rate of 3%, the real value of her money decreases each year. After a decade, her $10,000 will have the same purchasing power as $7,440 today. This scenario highlights the importance of understanding and planning for inflation. The impact of inflation on savings. When you stash your money in a savings account with a low interest rate, you're essentially losing money if the interest rate is below the inflation rate. Traditional savings accounts, often with interest rates around 0.5% to 1%, fail to keep pace with inflation, leading to a loss in real value over time. Imagine Felix, who diligently saves a portion of his income each month. He feels secure knowing he has a growing savings account. However, with an inflation rate of 2 to 3%, his savings are slowly eroding in value. The dollars he saves today won't have the same purchasing power in the future, affecting his ability to meet long-term financial goals. Felix's story mirrors the experiences of many savers. A 2020 study by Bankrate found that the average savings account interest rate was just 0.09%, while inflation averaged about 1.4%. This disparity highlights the need for savers to seek better returns to protect their purchasing power. The role of investments in combating inflation. Investing is a crucial strategy to combat inflation. Unlike savings accounts, investments have the potential to offer returns that outpace inflation, preserving and growing your purchasing power. However, not all investments are created equal in this regard. Equities, or stocks, have historically provided returns that exceed inflation rates. Over the long term, the stock market tends to grow, providing investors with capital appreciation and dividends. For instance, the average annual return of the S&P 500, a benchmark index, has been around 10% over the past century, significantly outpacing average inflation rates. Yet, investing in stocks comes with risks, as market volatility can lead to short-term losses. Diversifying your investment portfolio by including bonds, real estate, and other assets can help mitigate these risks while providing inflation-beating returns. Real-life story, Mia's investment journey. Mia, a 35-year-old teacher, realized the impact of inflation on her savings and decided to take action. She started by educating herself about different investment options and their potential returns. After reading Money Master, the game by Tony Robbins, she learned about the importance of diversification and long-term investing. Mia began by investing in a diversified portfolio of index funds, which offer broad market exposure at low costs. She also allocated a portion of her portfolio to real estate investment trusts, REITs, and Treasury inflation-protected securities, TIPS, which are designed to protect against inflation. Over the years, Mia's investments grew, outpacing inflation and significantly increasing her net worth. By understanding the implications of inflation and taking proactive steps, she secured her financial future. Mia's journey highlights the importance of informed investing as a means to protect against inflation. The importance of diversification. Diversification is a strategy that involves spreading your investments across different asset classes to reduce risk. A well-diversified portfolio can help protect against inflation by including assets that typically perform well during inflationary periods. For example, real estate often appreciates in value over time, providing a hedge against inflation. Commodities like gold and silver are also considered good inflation hedges, as their prices tend to rise with inflation. Including these assets in your portfolio can provide balance and stability, reducing the impact of inflation on your overall returns. Mark Victor Hansen and Robert G. Allen, in their book The 1-Minute Millionaire, emphasize the importance of diversification and multiple streams of income. They suggest that relying on a single investment or income source is risky, especially in an inflationary environment. By diversifying, you spread risk and increase your chances of achieving financial security. Inflation and fixed income investments. Fixed income investments, such as bonds, are often seen as safe havens. However, they are particularly vulnerable to inflation. Fixed interest payments become less valuable as inflation rises, reducing the real return on these investments. For instance, if you hold a bond with a 2% yield and inflation rises to 3%, your real return is negative. To combat this, consider investing in inflation-protected securities like TIPS, which adjust their principal value based on inflation, ensuring your investment keeps pace with rising prices. The role of real assets. Real assets, including real estate, commodities, and infrastructure, can provide a buffer against inflation. These assets tend to appreciate in value as prices rise, offering protection and potential growth. Real estate, for instance, not only appreciates, but also generates rental income, which can increase with inflation. Investing in rental properties or REITs can be a viable strategy to protect your wealth. Commodities like gold are traditionally viewed as safe havens during inflationary periods, providing a store of value when currency value declines. Personal anecdote: Zara's real estate venture. Zara, a software engineer, became concerned about the impact of inflation on her savings. After researching various investment options, she decided to invest in real estate. She purchased a rental property in a growing suburban area, leveraging the advice from the 1-Minute Millionaire. Over the next decade, the property's value appreciated significantly, and rental income provided a steady cash flow. The rental income increased over time, keeping pace with inflation. Zara's investment not only preserved her purchasing power, but also generated substantial returns, showcasing the benefits of investing in real assets. The psychological impact of inflation. Inflation doesn't just impact your finances, it also affects your psychology. Rising prices can lead to anxiety and uncertainty about the future. This psychological stress can influence your financial decisions, often leading to suboptimal choices driven by fear, rather than rational analysis. For instance, during periods of high inflation, people might rush to spend their money before prices rise further, leading to impulsive purchases and reduced savings. Alternatively, fear of losing money might lead to overly conservative investment choices, resulting in returns that fail to outpace inflation. Expert insights on navigating inflation. Experts like Warren Buffett and Ray Dalio offer valuable insights on navigating inflation. Buffett advises investing in businesses with strong pricing power, which can raise prices without losing customers. Dalio emphasizes the importance of a diversified portfolio, including assets like gold and inflation-protected securities, to hedge against inflation. Tony Robbins in Money Master the Game advocates for creating an all-weather portfolio designed to perform well in various economic conditions, including inflation. This approach includes a mix of stocks, bonds, real estate, and commodities, providing a balanced strategy to protect and grow your wealth. The future of inflation. What to expect. Predicting the future of inflation is challenging, as it depends on various factors, including economic policies, supply and demand dynamics, and global events. However, staying informed about economic trends and adjusting your financial strategy accordingly can help mitigate the impact of inflation. For instance, understanding the potential effects of government policies, such as stimulus measures and interest rate changes, can help you anticipate inflation trends. Staying informed and flexible in your investment approach allows you to adapt to changing economic conditions, ensuring your financial plan remains robust. Practical steps to protect your savings and investments. To protect your savings and investments from inflation, consider the following strategies. Diversify your investments. Include a mix of stocks, bonds, real estate, commodities, and inflation-protected securities in your portfolio. Invest in real assets. Real estate and commodities can provide a hedge against inflation. Stay informed. Keep up with economic trends and adjust your financial strategy as needed. Focus on long-term growth. Invest in assets with the potential for long-term appreciation to outpace inflation. Consider professional advice. Consult with financial advisors to create a tailored investment strategy that accounts for inflation. Real-life application. Ava's financial plan. Ava, a marketing executive, wanted to ensure her savings and investments were protected from inflation. She started by diversifying her portfolio, including a mix of index funds, REITs, and TIPS. She also allocated a portion of her investments to gold and other commodities. Ava regularly reviewed her financial plan, staying informed about economic trends and adjusting her strategy as needed. By taking a proactive approach and seeking professional advice, she confidently navigated the challenges of inflation, securing her financial future. The historical perspective on inflation. Understanding the historical context of inflation can provide valuable insights. Throughout history, periods of high inflation have often followed economic upheaval, such as wars or financial crises. For example, during the 1970s, the U.S. experienced high inflation rates due to oil price shocks and expansive monetary policy. This period, known as the Great Inflation, saw annual inflation rates reaching as high as 14%. Those who held cash or fixed-income investments saw their purchasing power plummet, while those who invested in assets like real estate or stocks were better protected. Drawing lessons from history, it's clear that maintaining a diversified portfolio and staying informed about economic policies are crucial for protecting your wealth from inflation. The global impact of inflation. Inflation is not just a local phenomenon, it has global implications. In today's interconnected world, inflation in one country can affect economies worldwide. For example, rising inflation in major economies like the US or China can lead to increased prices for goods and services globally, impacting consumers everywhere. Global events such as trade wars, pandemics, or geopolitical tensions can also trigger inflation. Understanding these dynamics can help you make more informed investment decisions. For instance, during the COVID-19 pandemic, supply chain disruptions led to price increases for many goods, highlighting the importance of being prepared for unexpected inflationary pressures. The role of technology and innovation. Technology and innovation can play a significant role in mitigating the effects of inflation. Advances in technology can lead to increased productivity, which can help keep prices stable. For example, improvements in manufacturing processes or supply chain efficiencies can reduce costs and limit price increases. Investing in technology companies or sectors that drive innovation can be a way to protect against inflation. These companies often have the potential for high growth, which can outpace inflation. Moreover, technology-driven efficiencies can benefit consumers by keeping prices lower than they might otherwise be. Preparing for retirement in an inflationary environment. Planning for retirement requires special consideration of inflation. As you plan for retirement, it's essential to ensure your savings and investments can sustain your purchasing power over decades. Relying solely on fixed-income investments like traditional pensions or bonds might not be sufficient. Consider incorporating growth-oriented investments like stocks and real estate into your retirement portfolio. Additionally, annuities with inflation protection can provide a steady income stream that keeps pace with rising prices. The key is to balance growth and security to maintain your lifestyle in retirement. Personal experience. Leo's retirement strategy. Leo, a civil engineer, realized that his pension and savings might not be enough to cover his retirement expenses in the face of inflation. After consulting with a financial advisor, he diversified his retirement portfolio by adding dividend-paying stocks, REITs, and TIPS. Leo also invested in an annuity with inflation protection to ensure a steady income stream. By taking these steps, he created a retirement strategy that balanced growth and security, providing peace of mind for his golden years. Adapting your budget to inflation. Adapting your budget to account for inflation is another crucial strategy. As prices rise, it's essential to adjust your spending and saving habits to maintain financial stability. Regularly reviewing your budget and identifying areas where you can cut costs or increase savings can help mitigate the impact of inflation. For example, you might consider reducing discretionary spending, such as dining out or entertainment, to offset rising costs for essentials like groceries and utilities. Additionally, increasing your contributions to retirement accounts or investments can help ensure your savings keep pace with inflation. Community insights, financial literacy programs. Many communities and organizations offer financial literacy programs to help individuals understand and manage the impact of inflation. These programs provide valuable resources and education on budgeting, investing, and planning for inflation. Attending workshops or seminars on financial literacy can enhance your understanding of inflation and its implications. Engaging with financial advisors or joining investment clubs can also provide support and guidance in navigating inflationary pressures. Conclusion: navigating inflation with confidence. Inflation is an inevitable part of the economic landscape, but it doesn't have to erode your savings and investments. By understanding its implications and taking proactive steps, you can protect and grow your wealth. Remember the key takeaways from Money, Master the Game, and The 1-Minute Millionaire. Diversify your investments, focus on long-term growth, and stay informed about economic trends. With these strategies, you can navigate the challenges of inflation with confidence and secure your financial future. Answers to the initial quiz. 1. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. 2. Inflation impacts the purchasing power of your savings by reducing the real value of your money over time. 3. Inflation influences your investment returns by requiring investments to achieve higher returns to outpace rising prices. Investing in assets with the potential for long-term appreciation and diversification can help mitigate these effects. Success in business isn't about luck. It's about learning, adapting, and taking action. The more you invest in knowledge, the better your results will be. If this video gave you new insights, smash that like button and let us know in the comments. And if you're serious about growing your business, subscribe to the channel and turn on notifications so you never miss out on expert tips. Plus, join our community absolutely for free to get more information on this topic. We're building a space where ambitious minds can grow together. Don't miss out. We've got even more free insights waiting for you. Click the link in the description and unlock the next step on your journey.